Mike Muller, let's kick off with you. I mean, a month ago when we sat together, the oil markets looked a very different place, very fragile. The pricing had come off quite strongly after the OPEC Plus meeting, and I think we actually met on the eve of the OPEC Plus meeting. So the oil price was already taking a hit from the news from that, but the news came and the oil price collapsed. But it has since come back very strongly. A month out from the OPEC Plus meeting, your thoughts on the other sort of big events as to why that price recovered? Where do you see the health of the market supply demand at this point?
Yes, we're up $10 off the lows from 77 or thereabouts to $87.20 Brent as we $87.22 as we speak. And there are a number of factors, but the ones on everyone's mind are hurricanes, Hurricane Beryl in particular, which may already have peaked in terms of the concern factor. And I mean, not related to oil, of course, the elections, which form a backdrop, but the ones we're seeing right now don't have a bearing on the immediate price of oil. But then people's prognostications on forward demand catching up with supply, and people may be giving a little bit more credence than they did initially to the outcome of the last set of OPEC Plus meetings. So the market responded to the initial slump in prices by observing that there was a risk-off mindset and that managed money had essentially exited the energy commodity space, and that changed. So we've had a reasonably substantial inflow, and that has not just sent the flat price up $10, but we have a backward structure which tends to fuel the interest in being long, because you get the positive roll yield effect as you roll your front month into your second month every month, and that's a premium you're collecting, which at current levels exceeds the returns you'll get by investing in bonds or fixed term interest or whatever it might be. But there does seem to be a stronger sense of belief that fundamentally the supply demand equation in oil is likely to tighten going into, well, we're already in Q3, but going into the back end of this quarter, and particularly so in crude. On the product side, there's expected to be an adequately supplied picture. However, we still have the state of affairs where ships are going the long way around the Cape of Africa and avoiding the trouble spot in the Bab el-Mandeb, and that continues to see high inventories on the water, but not necessarily as high a set of inventories in the destination markets. There was a higher degree of concern on inventories in China and on the incentive to export, but of course that's limited by export quotas in China, and therefore there hasn't been any response to low prices, depressed fundamentals inside of China flooding the market to quite the extent that we expected. And there are plenty of arbitrages open, which have seen yet more oil go onto water, even though inventories seem to have come off in recent weeks. There is a sense that there might be an increase again as we see large shipments of fuel and diesel travel longer haul. So an overall more resilient, tighter picture. And this is backed up by commentaries from expert advisory firms and advisory divisions of investment banks, where the range of estimates is still wildly apart. I mean, the range of estimates gives you a bullish picture and a bearish picture, but on average, the midpoint of those numbers is a slightly firmer consensus, and that's, I guess, why we're in the mid to high 80s now.
Mike, I mean, looking at the month of June, obviously the OPEC decision, the OPEC Plus decision, which came, obviously there was a collection of decisions that were made on that day in June, the first Sunday in June, where OPEC Plus agreed to roll over their quotas, their current production cuts, if you want, right through to the end of 2025. So added a whole year to that. So it gave a real sort of outlook detail for the whole group, 22 countries, till the end of 25. Then they also agreed the 8 countries, which were the OPEC plus 8, the great 8, I think the UAE minister called them, announced their decision to roll over their additional voluntary cuts, as they're called, by 1 quarter, this quarter that we're in now, the third quarter, and then by the fourth quarter to start unraveling those cuts. So I just wonder, and unraveling them by announcing that in great detail, month to month, for every one of those 8 countries. Firstly, I wanted to get your thoughts on the level of detail that they presented for the sort of 16, 18 months outlook to the end of 25, or the level of detail in the grade eights unraveling. Your thoughts on that?
Yes, there was initially a mixed reception, if not a negative reception, to what by all accounts was a rather well prepared meeting when they convened the inner circle, if you like. And because that led to a speculative sell off in markets, because the markets had been presented with not one, but with multiple targets that OPEC Plus might then go and miss. It was rapidly followed up by a set of communications from key producers, which included some aspects that did show up confidence. For example, there are a set of countries that have statistically overproduced, and some of them were seen stepping forward and confirming to the media that they were going to observe a program whereby those overproduction figures would be corrected and those production numbers would be reined in order to restore the balances that OPEC Plus had pledged to see into the market. So that was just one of a few signals that came through, and it showed solidarity. It showed that there was cohesion because a significant number of those particular countries, some of them aren't particularly material in terms of total output, but the chorus was in unison. It was harmonious. It wasn't disharmonious, right? It wasn't a cacophony of potential discord. And that's what the market was expecting to see, right? There's a constant push from those countries that have invested heavily in having a much greater capacity than their headline number under the OPEC Plus agreement to rattle the cage and wish to export more. And if those very same countries are seen making supportive noises following the convening in Saudi Arabia, then I guess the market took heed of that. Now, I must confess, I'm quite surprised to see the market up $10 on that alone, and I don't think that's the only reason. I think we do need to focus on the hurricane that's currently, with no need to sort of talk in terms about those that are about to come into the path of it, but it's heading for the Yucatan Peninsula, and it's going to be in Brownsville, Corpus Christi, by all accounts, with pretty accurate tracking at the weekend. This storm weakened over Jamaica, where it did a lot of damage, and has strengthened to Category 3. That is a serious storm. But what people are taking much more seriously is that there has never been a Category 5, which this one was. Beryl was a Category 5 before barreling into Jamaica. This early in the season, it was the 1st of July, and that is very early. And the reason is that ocean surface temperatures in the Caribbean, in the kitchen for hurricanes, if you like, to the east of Barbados, Grenada, is way, way warmer than it's ever been. And this, of course, has the tongues wagging about the prospects of a very, very busy hurricane season that will cause operational disruptions. Now, depending on
what amount of oil production would be under risk there in not this weekend, but on general in the Gulf of Mexico, any given storm?
You look at production, you look at refineries, right? So the track of the hurricane is tracking over the north of the Yucatan Peninsula. That is a significant production zone for the heavier Mexican grades of crude. And there's only one refinery anywhere close to there. Most of the Mexican refineries are much further to the west. But then the prospect of the hurricane barreling into Corpus Christi is all about how much the hurricane weakens or strengthens as it tracks across the eastern Gulf of Mexico, the western Gulf of Mexico, and hits the Corpus Christi center, which is a significant refining center. So the harm to production now and the precautionary shutdowns in Mexico are bullish high sulfur crude. In a couple of days' time, there'll be shutdowns of refineries because the track of this particular hurricane is well to the west of most of the offshore producing regions in the Gulf of Mexico, which are pretty much off the Mississippi Delta, and therefore are likely to cause more excitement in products. And you've almost had a correlation between products cracks and the category severity of this hurricane. When it was a Category 5, the markets got the most excited. When it weakened to a lower degree on the Saffir-Simpson scale, the products cracks took a breather. So given that most of the news will be over the weekend when markets are closed, Monday could be interesting.
Just picking up on that, I mean, again, we just noted at the beginning of Christoph's comment there, this disparity between OPEC Plus and IEA, and clearly it feels like, given the current half year already done, we're likely to be more in line with the IEA 1.1 than the OPEC 2.2. But in either case, looking ahead, Mike, the third quarter, I see that beautiful map of China behind you. Where do you see China? Can China roar back to anywhere close to, I mean, never mind the OPEC numbers, even meeting the IEA numbers now might be a little bit of a challenge.
No, I don't agree. The IEA numbers are a challenge. I think the consensus amongst market participants and banks heavily involved in the sector are still clustering around the middle between those two numbers. So mid to high 1.6, 1.7 million barrels a day year on year. The messages from China in terms of what real-time data is available have actually shown a slight uptick in demand in recent weeks, which really just unpicks the disappointing downtick in demand we saw a couple of weeks prior, so in the middle of June. But as such, that was an end of a worrying downtrend in Chinese demand. And even though economic indicators out of China still typically are bearish rather than bullish, we have to remind ourselves that the Chinese market is still growing. There's so much talk about electric vehicle policy and taxation of vehicles into economies in the West. But the combustion engine sales are still on the up in China also. There just happens to be a lot going on in terms of vehicle pricing policies and international trade in cars made in China. And the numbers look particularly interesting on diesel, which has been holding up as a product. And then, of course, boosted by the hurricane, as I mentioned a few minutes ago, when it was barreling across at 5, right, on the scale. So we must never forget China is not as dependent as it used to be on international markets and has a self-sustaining domestic economy. I was there a few days back. I'm flying there again tonight. The cities are busy, right? My guys are telling me the equivalent of the PMIs, the indices on the state of the manufacturing sector are hovering at numbers that are not too disappointing versus expectations. So I'm not sure
but
how
ultimately,
much
looking forward, Mike, the China's ability to export their way to growth as a model is clearly ending. It's not only ending out of their own choice, perhaps, but also with the increasing scales of sanctions and duties that they're facing at 100%, for example, on EVs going into the US. That the exporting model as being the sort of the source of that incremental demand growth that we've seen for 20 years now, that's coming to an end, no?
Yeah, I guess that's what I was getting at. The Chinese dependency on the containers across to Long Beach or across to Europe is not what it used to be. China has a very great capacity to sustain its own economy based on domestic consumption. And of course, a growing services sector, et cetera, et cetera. So yes, the demographics aren't there to fuel the population pyramids. The bulge is in the middle somewhere, not at the younger generations, thanks to the one-child policy. But my guys aren't too downbeat. They're not coming back from their multiple China visits. I've got a team in China every week going, "Oh my gosh, Mike, it's looking terrible." It's I'm not sure it's going to get much worse. I think that's the mood.
Mike, I mean, looking forward, obviously, we're already trading deep into the third quarter and into, obviously, deliveries into the fourth quarter. Where do you think the OPEC plus decision or OPEC, again, the 8 countries within OPEC that have announced the decision to raise supply by 500,000 barrels a day in the fourth quarter over the course of the fourth quarter, does the market fundamentals look there to support that next step by those countries?
There's the call to be made on non-OPEC production as well. Everyone talks about the very substantial volumes coming out of Guyana and continued investments in the very investment-intensive Brazilian deep water in particular, but also Gulf of Mexico. But to answer your question, they should be happy because, I was tempting fate here because you said we're close to 1985. Actually, that's what it was when we spoke, but you're actually right now because it's printing 87.49. So this is the highest price we've seen since April. So it's gone up 11 cents since I scribbled that when you spoke before. So I mean, $87.50 is a pretty healthy number given the excess supply cushion or the spare capacity, as we call it, that Christopher alluded to.
Do you think that price beds in the fact that they are raising supply coming the fourth quarter, or does it bed in the warning from the Saudi minister when he said, well, maybe we can change our mind? I mean, which of those two do you think the market's betting into that price?
I can't tell you what Vitol's betting. It's got
price.
multiple teams who've got different views on this, but
yeah.
my suspicion is they are betting in the announced increase, because you look at history and the participants in OPEC Plus have a history in some cases of straying somewhat above their numbers. So there's no reason to believe they're not going to continue doing so and being tempted to. And therefore, the market is definitely not assuming that they'll put less into the market. Participants will only do that if they see a country that's going to struggle to achieve those numbers, whether it's for disruption reasons such as weather, or simply the fact that they've been given a generous quota and there hasn't been enough investment, or they're a mature province where some of the African nations in OPEC, for example, have struggled to keep pace with their numbers. I can name a couple, but we know who they are.
Yeah. Just last word to you on that. Not wanting to ask you to get into the weeds of the politics of this, but one of the big factors in the energy markets over the last year that hasn't really sort of arrived has been the scale of the sanctions on Russian exports, on Iranian exports. They haven't been curtailed. Iran is exporting more than it has in 5 years. But your thoughts, Mike, on the possibility that with these election results, a more right, although in England it's more moving to the left, the UK to the left, but your thoughts, the election results having some bearing on how these sanctions are implemented and whether easing or strengthening and relevance to the energy markets? You had said earlier not much relevance.
Yes, in my view, the trend to the right in Europe is unlikely to change the degree of support for Ukraine and the negative sentiment towards Russia. You saw Brussels last week come out with a further step of measures to make it very difficult for European headquartered firms to allow supplies to Russia via their non-European affiliate organizations. And you also saw a couple of destination countries in Asia that were happy to take Russian origin blended barrels from places like the Middle East into their operations, cease to do so on the basis that the banking channels and maybe their conscience make it a bit more difficult to do so. And the second thing that's happened is there's a lot of talk now around the Russian LNG, which has been exempt in order to stop fueling the more volatile of the energy commodities, namely natural gas, in Europe in particular. And there's a perception now that there'll be a point reached at some point where not allowing Russian gas into those markets will no longer have the inflammatory effect that it used to have. So those two measures are significant. They're causing a change in behavior, but they're probably just going to drive those flows into the hands of companies that are willing to do it, that have no nexus with Europe whatsoever, and possibly onto cheaper shipping, which brings with it a fresh set of concerns on quality of the global energy transporting the oil tanker fleet. So I think it's a hiccup, but markets have shown over time that oil finds ways of flowing to markets. But there'll be new players, new entrants, and there might be the odd hiccup here and there, and there'll be plenty of oil on the water, I suspect.